In the method of depreciating, especially the method of depreciation in the question number 3 is WDV. Anyhow, we work on the same illustration under SLM method also. Here we have multiple assets purchased, and halfway through again we purchase some of the assets sold. So one of the comprehensive illustrations for your understanding. Right. Let me explain this in a basic working style. Then the next one will be, I'll just try to solve this illustration in an advanced manner to get the answer directly. And some of them may be sold the halfway through. So lots of assets are there, not one single asset. Now and then we'll purchase constantly some assets, and constantly some worn out assets could have been sold. In that case, how can you prepare the asset account? Yeah, of course, you can prepare the asset account directly, making small working note, or you can prepare the method of depreciation format for each and every asset independently. And then you group that group can be simply posted in the combined asset account. In both the way we can solve that. The first time I'm going to solve this in this illustration, I'm going to solve this under individual assets model. Each and every assets will be separately treated. And after that, I'll just straight away go for solving that illustration in a collective model, so that it will compare the difference between both the methods. Yeah, of course, both the methods will be accepted and you can get the mark, but the second method will be time consuming. So it means first method being the time consuming, second method being the time savings. So if you are being the professional students, your time allotted for the examination is very lesser. See, this illustration was asked in CMA Inter for 6 marks only. For 6 months, for 6 marks, hardly you can give around 7 to 8 minutes only. At the maximum 10 minutes. Within 10 minutes, you have to solve. But if you want to solve that for individual assets based model, then it takes lots of time. But for the beginning, at the time of understanding, you can work out under single asset model. Each and every assets are worked out individually. Assume that we have 4 machines purchased at rupees 2,60,000 each on 1st April 2010. So 1st April 2010, okay, original value, 2,60,000, how many assets purchased? 4 assets, again 2,60,000, again 2,60,000, again 2,60,000, 2,60,000. We have 4 assets purchased on the date. Asset 1, asset 2, asset 3, asset 4. And on 1st April 2011, this is the next year. So with that, the first year is over. So for the first year, you have to provide the depreciation. This is for first year. On 1st April 2011, the next year, the day 1 itself, one machine was sold for rupees 2,05,000 rupees. Out of the 4 assets, 1 asset seems to be unfit, so sold. This is for the second year adjustment. On 1st July 2012, okay, 1st July 2012, the second machine was destroyed by fire insurance. Claim received 1,75,000 on 15th July 2012. This will be the third year information. So first year we purchased 4 assets. In the second year, in the very first year itself, first day itself, we sold one of the unused assets. In the second year, one of the assets were lost in fire accident and was insured. So we received the insurance claim also on 15th July. So these are the 3 things happening in 3 different years. And a new machine costing 4.5 lakhs was also purchased in 1st October 2012. This is also happens only in the third year. Third year, 2 things happen. One is fire accident, and in order to replace the assets destroyed in fire accident, we purchased one more assets on 1st October. And the books are closed on 31st March every year. So year end will be 31st March every year. And depreciation has been charged at the rate of 15% per annum under diminishing balance method. So we have to provide the depreciation under diminishing balance method. You are required to prepare machinery account for 4 years till 31st March 2014. Now, year after year, I am going to work out that here. 1/1/2010, in 2010 and 11, the very first year, only purchases happens. There is no any other means a sale or additional purchases happen. For these assets, now I am going to provide the depreciation. Come on, So year 2010 and 11, 2010 and 11 depreciation for the first year. 15 percentage at the rate of 15 percentage, that to WDV method. WDV method rate of depreciation is 15 percentage. 39,000. So very good. So start interacting with me by posting your answers in the chat box also, no problem. For all the four assets, the amount of depreciation being 39,000 rupees in the very first year. I'm solving this under WDV as well as I will solve that under SLM after, right? Okay. 260 and 39 and 31/3/2011. This is the WDV value. WDV value being 2 lakhs 21,000. 2 lakhs 21,000. 2 lakhs 21,000 and 2 lakhs 21,000. So first year is over. First year over. In the second year, the day one itself, one of the assets, I assume that the first asset sold. Okay. Sold for how much? 2 lakhs 5,000. If any asset sold, it's better to have a separate working note for that. Okay. Whenever we sell any of the asset, you can work out separately. Now, as on 31/3/11, the WDV being 2 lakhs 21,000. Is there any depreciation for the year of sale? No. The day one itself, the asset sold. As the asset sold in the day one itself, we won't provide any more depreciation for that year of sale. And as per my book, it is valued at rupees 2 lakhs 21,000. But this one is sold for how much? 2 lakhs 5,000 rupees. I sold it for 2 lakhs 5,000 rupees. As per my book, the value of the asset being 221 but sold for 2 lakhs 5,000. It means I lost. How much I lost? 16,000 rupees being the loss. Okay. This happens in year 1, year 2. Okay. Working note number. This is 1 and this is 2. Okay. This is all about for year 2. It happens in year 2. So hereafter, you never bother about the asset 1. Now we have to provide the depreciation for the remaining assets. So in the second year, 2011 and 12, we have only 3 assets. Out of the 4 assets, 1 asset was already sold. We have only 2, 3, 4. Only these 3 assets we have. For these 3 assets, we have to provide the depreciation for the second year. So for the year 2011 and 12, yeah, come on. What's the value? 33,150. 33,150 and 33,150. No other things happen in the year 11 and 12. So we have to subtract this depreciation for the year 2. After this, we'll get the WDV as on 31/3/12. WDV. The WDV here being 2 lakhs 21 for the first year. What about the second year? 2 lakhs 21 minus 33,150. The first one is nil, right? Sorry. Okay. This one is 1 lakh 87,850. Okay, 850. That remains constant for all other assets also. 1 lakh 87,850. 1 lakh 87,850. We got it now. 31st March 2012. Now, in the year 12 and 13, the third year, 2 things happened. One is one of the assets were destroyed in fire accident. Another one is purchase of a new asset. For the destroyed of the one of the assets, right, here is. On 1st July 2012, the second machine was destroyed by fire. An insurance claim was received 1,75,000 rupees on 15th July. I assume that the second asset is going to be lost. For this asset, I have to provide the depreciation as in the date of loss. So I'll skip this. This will be separately worked out. Number 2. Number 3. The value being 1,87,850. 1,87,850. What is this? This is the WDV as on 31/3/2012. whenever we sell any of the assets up to the date of sale, you have to provide the depreciation. For this asset, the depreciation is provided as on 31st March only. This asset is sold on which date? Our fire accident is happen on 1st July. So this particular asset is eligible for the 3 months depreciation. April, May, June. July 1st, right? So April, May, June. 3 months depreciation will be provided. Come on, get that. 7,044. Now the WDV or book value as on the date of fire accident being 1,80,806. 1,80,806. And this one is sold for, not sold for, insurance claim received for 1,75,000. We get less than its real worth. We thought it is 1,80,000, but we got only 170. We lose how much? 5,806 is the loss. See, whenever the asset is sold or destroyed, or if you want to dispose of from our books, from our usage, remove it properly and calculate it separately. So I have removed and calculating that separately here. So 1,75,000 and 5,806. This is the value. Now we don't have the second asset. In the same year, we purchased one more asset also on 1st October for rupees 4,50,000. So fifth asset is going to be purchased. Asset number 5. Asset number 5. The date of purchase being 1st October. 1st October 2012. The value of purchase being 4,50,000. The value of purchase being 4,50,000. Is that okay? Any doubts? So now we have to provide the depreciation for the year 2012 and 13. For this 1,87,000, 1,87,850. For that, you have to calculate depreciation at the rate of 15%. The value being 28,000. 28,178. 28,178. In the case of lost asset, 4.5 lakhs into 15%, but was purchased only on 1st October. So from the 1st October to the year end, half year will be there. So you have to calculate the depreciation for the half year. So the value being 33,750. 33,750. Now after that, you will be getting what? WDV value. WDV value as on 31/3/2013. Okay. WDV. First asset is not there and second asset is also not there. Third assets, no. Okay. So the last assets being 4.5 lakhs minus 33,750, 4,16,250. So this will be 4,16,250 will be the value. And third and fourth, third and fourth is also there. The WDV of the third and fourth year as on the year beginning of the current year of accounting, 1,87,850, and depreciation for that year being 28,178. After that, the WDV being 1,59,672. 672. 1,59,672. Is that okay? We got it now. Now we have to find out the next year depreciation. Depreciation for this is 13, right? This is 13. Now we have to calculate the depreciation for 2013 and 14 because we supposed to prepare up to how long? 4 years till 31st March 2014. So for the last year, we don't have any other adjustments. So directly claim the depreciation. First assets not there and second assets also not there. For the third assets, as per the book value, it is 1,59,672. For that 15% being 29,950. 951. So 23,951 and 23,951. And finally, the last assets 4,16,250. For that 15% will be calculated. That value being 62,438. Now the WD value by the time is for the last assets the 3,53,812 and 3 and 4, the asset 3 and 4 will be 1,59,672 minus 23,951, this value being 1,35,721, and fourth asset will also be valued at the same value, 1,35,721. Now take a total of this. Okay, this is third year. Now I need to have the total here. Total here. Total of all the original assets, the very first 2,60,000 into 4. How much is that? 10 lakhs 40,000 rupees. 10 lakhs 40,000 rupees. And the next depreciation sum up of all these things, 1,56,000. If I subtract that 1,56,000, then I will be getting the WD value. Yeah, how much is that? 8,84,000. And then depreciation for the second year, 3 depreciations are going to be clubbed. 99,450. After subtracting the value being, yeah, come on, 884 minus 99.45, 7,84,000. 7 lakhs, okay, 7,84,550. And again one more asset is also purchased, which is 4,50,000. Now depreciation for 12 and 13. No. 8 lakhs, 1 lakh is subtracted, means by default 7 lakhs. No, do the double calculations. And the depreciation for 12 and 13, 28,178 plus 33,750, this value being 90,106, and then the WDV being, the WDV as on 31st March, 1,59,672, and 4,16,250 will be added. So this value being 7,35,594. The depreciation for the last year, 23,951 for 2 years, 2 assets, and 62,438, this value being 1,10,340. Okay, if I subtract that value from 7,35,594, then the WD value for all the assets exist as on the last year, 6,25,254. So I have worked out the depreciation and WDV for each and every assets individually. This will be an extensive working note. Then I will work out the same illustration without working in the so lengthy process, so that we'll get the answer easily. Now let's solve this illustration or post that in the ledger. So I am going to prepare the ledger here, asset account. Let's see. Asset account. Now hereafter it's very simple. Asset account. Very first, on this date I am purchasing an asset for 10,40,000 rupees. So 1,410 asset account debit to bank. The value being 10,40,000. 10,40,000. And depreciation by the year end, for that year, calculated by the year end 31/3/2011, depreciation this value being 1,56,000. No more adjustment is there. So 10,40,000 and 10,40,000. The balance carried on was also already available. 8,84,000. So simple. 8,84,000. Rewrite here 1,411. Balance brought down 8,84,000. 8,84,000. And depreciation in the second year, one asset is also sold, then automatically these information is also going to be incorporated. Sold for 2,05,000 on the year beginning. The sale date is 1,411. Bank, the amount collected by selling the asset being 2,05,000. And because of this sale, we lose 16,000. That reduces the value of the asset. So I put the value in the credit side, loss on sale, the value being 16,000. Remember, from the 884, if I subtract these two, whatever the balance I get, that balance is nothing but balance of all the existing assets before the depreciation. Before the depreciation. On that also you can directly calculate the depreciation. See that 8,84,000 minus 2,21,000. For that, if you calculate 15%, that amount of depreciation should be 99,450. Cross verify that. So for the year end, 31,312 depreciation for all the existing assets, 99,450. 99,450. If I tally this, I will get the balance again. 8,84,000. 8,84,000, and then the balance carried on here being balance carried on. Also, we have already found out that 7,84,550. 7,84,550. Now, go to the next year. 1,413. Balance brought down, the value being 7,84,550. We are in the third year. In the third year, what happens? This will be incorporated. Working note number 3, where one of the assets was destroyed. The treatment for any fire accident or theft or sale will be the same. Here also one of the assets, in the year beginning, it is valued at rupees 1,87,850. Is subject to depreciation for the current year being 7,044. 7,044. After this depreciation, we thought it is worth rupees 1,80,806. Sold for, not sold for. Amount realized by insurance company is 1,75,000. Balance will be the loss. I am going to post that here. As on the date of fire accident, the fire accident happens on 1st July 13. On the date, depreciation will be charged separately. This is nothing but the depreciation of the asset sold up to the date of sale. Number 1. The earlier year, we sold in the year beginning itself, so we don't have any unadjusted depreciation for that second year. But in the third year, the asset was used for a couple of months, around 3 months already used. So we have to provide the depreciation for the 3 months first of all, and whatever the balance left over, compare with the sale price to determine if there is any profit or loss. Of course, there is really loss also. And the 1,75,000 rupees is nothing but insurance claim received. The due date. The thing happened on 1st July, but the amount realized later, probably 15 days later. So we can pass a due entry, insurance claim account debit, like rather than bank account, we can pass the entry as insurance claim. We collect that money when 15 days later, right? So as we collect the money 15 days later, by the time bank to insurance claim, that's how you can pass due entry, or you can directly post here, omitting that one. On 15th, we collect the bank. That way also it will work. Okay. Wait. This balance, wait. 8,84,000 minus 99,450. Okay. Then add 450. Okay. Now we'll get this balance, right? Okay, once again I'll correct here. Tell me what's the value? 5 lakhs? Yeah. 5 lakhs? 60? Ah, 550. Okay, I'll stand corrected here. This value is now corrected. Okay. 5 lakhs 63,550. 550. So this opening balance being 5 lakhs 63,550. Okay. Okay then. Okay then. Is that clear? Don't do subtraction. Addition. It's only addition. So we have to add these three to get this value. Don't subtract 99,450 from 8,84 to arrive this, because there is one of the assets sold. That value is eliminated. No. Was removed? No. So it's better do this way. Additions of all this column. So here the insurance claim amount received being how much? Insurance claim 7 lakhs 1,75,000. We received that insurance claim less than what we expected, what our book value shows. So that will be loss. So that will be now loss on sale, loss on fire accident. The value being 5,806. And what happens? Any more thing happen in the third year? Of course, in the third year we purchased one more asset for 4,50,000. The date of purchase being 1st October. So on 1st October 2013, bank, the value here being 4,50,000. Now we can tally this. If I tally this, 10,13,550, and we have to provide the depreciation for the third year. The depreciation provided for the year 12 and 13 being 90,106. 90,106. This is the depreciation. After that, if I tally 10,13,550, the balance I will get by this time being 7,35,594. Hope so you could understand. And for the next year, 1/4 to 2014. Okay, 2000 started with this is 12, I think so, right? This is 12. Ends with 31,313. So I start with 1/4/2013. Balance brought down being 7,35,594. 594. Now the depreciation for these assets for the year 13 and 14, claimable or chargeable only in the year end 31/3/2014. Depreciation, no more purchases and sales happens in the fourth year. Only depreciation is provided, which is 1,10,340. If I tally this, so this value being 7,35,594. 7,35,594. Then you will get the balance. The balance being 6,25,254, and carry on to the next year beginning 1/4/14, 6,25,254. We supposed to prepare only for these 4 years. You no need to carry on further. Is that clear? Yes, come on, make a note of it. Calculation to be shown nearest to rupee only, right? So you no need to consider about the paise here. And we start with 1st April 2010, and we have to work out the machinery account for 4 years. Let's see here. Machinery account. Machinery account. Machinery account on 1st April 2010. Bank. 4 asset purchased Each and every asset costs us 260. So you have to multiply 260 with 4. So 10 lakhs 40,000 rupees is the purchased value. And what are the other things are there? On 1st April 2011, 1st April 2011 is all about 11 and 12, second year. One machine was sold for rupees 2 lakhs 5,000 rupees. This information is for the second year. I never care about this for the first year's working. This is for second year. On 1st July 2012, this is all about 12 and 13. One more year later. The second machine was destroyed by fire and insurance claim received on 15th July 2012. So in July 2012 means 12 and 13 year. In that year, one asset was totally destroyed in fire accident and insurance claim is also receivable. We thought the asset have been insured. And this is all about for which year? Third year. This is for third year. Okay. And a new machine costing 4.5 lakhs was purchased on 1st October 2012. It is also 12 and 13, the same third year. Third year, what happens? One asset was destroyed, another asset was purchased. Two things happening. Right. Books are closed on 31st March every year and depreciation has been charged at the rate of 15% per annum under diminishing balance method. So year end being 31st March and the depreciation rate being 15%, method of depreciation being diminishing balance method. Right. So 15% is the rate of depreciation, the method being WDV. You can make a note of this. In the very first year, we purchased and used, no more transaction, no more sales or no more other purchases available. So we can directly calculate the depreciation for the year by the end. Year end being 31/3/2011 depreciation. The depreciation on 10 lakhs 40,000 rupees at 15% being, how much is that? 1 lakh 56,000 rupees. And you can tally this, no more transaction, no, I will close this. 10 lakhs 40,000 rupees. 10 lakhs 40,000 rupees. And the balance I am getting here, balance carried on as in the date being 8 lakhs 84,000. Now I will transfer that to the next year. 1/4/2011 balance 8 lakhs 84,000. 8 lakhs 84,000. For the second year, one adjustment is there, no. One adjustment is there, no. So immediately finish up that adjustment. What is that? On 1st April 2011, one machine was sold for rupees 2 lakhs 5,000. Working note number 1. On 1/4/2010, original value of the one of the assets sold being 260. For this asset, we have used 10 and 11 completely. So the depreciation eligible for that year being 39,000. 2 lakhs 21,000 rupees is the value as on 1/4/11. 1/4/11 or 31st March 2011. Both are same book value. And what about the date of sale? The date of sale is exactly on 1/4/11. So for that current year, it is not eligible for any more depreciation because not even single day is used. So for the 2 lakhs 21,000, we can compare with the sale price. This asset was sold for how much? 2 lakhs 5,000 rupees. As per my book value, the asset is valued at rupees 221 but sold for 2 lakhs 5,000. I lose 16,000 rupees. This is loss on sale. Okay, this is collection amount. Now I am going to incorporate any asset sold, right? So you have to make a working note for that asset of sold separately. By preparing that separate working note, find out any depreciation for the current year of sale. Current year of sale means 11 and 12. I am preparing the account for 11 and 12. Is there any depreciation for the year of preparation here? No, because the asset was sold in the day one itself, so it is not eligible for any depreciation in that year. Forget about that. Rest of the things can be posted. Depreciation in this case is 0 for the current year. And bank 2 lakhs 5,000, lost 16,000 rupees. Both are going to be recorded in the credit side. The date of this being 1/4/11. Bank, the amount collected by selling the asset being 2,05,000, and because of this sale we are not gaining but we are losing. Loss on sale. If it is being a profit, it should be in the debit side. Mind that. So here it is 16,000. And we don't have any other transactions, only this sale. Now we have to find out the depreciation for the year end. 31st March 2012. Depreciation. How do I get the depreciation? Not only depreciation, after the depreciation I will be getting the balance carried out. Balance carried out. Clear? Now, come on, get me the depreciation here. So the way of getting the depreciation is pretty simple. Here this one, these two are from working note number 1. Now for getting the depreciation for this year being, I am doing that in a second working note. Balance of machinery account for or on balance of the machinery account, okay, on 31/3/12 before charging depreciation, because we are not aware about the depreciation currently. So I'll name this being before depreciation. Now what is the value? 8,84,000 minus 2,21,000. This value being 6,63,000, isn't it? For that 6,63,000, you have to claim the depreciation at the rate of 15%. 99,450. And after that, balancing figure 5,63,550. Am I right? So I am going to post. So here the depreciation for the second year being 99,450, and balance for that year being 5,63,550. Now it gets automatically closed. So simple, right? 8,84,000, 8,84,000. We'll move on to the next year, 1/4/12. The opening balance here being 5,63,550. And in third year, we have two adjustments. One asset was sold, was destroyed in the fair extent. Another asset was purchased. So now the destroyed asset. That destroyed asset purchased on 1/4/10. Okay. Let me now brief that third point only. In the third point, what are the things we have? On 1st July 2012, the second machine was destroyed by fire. An insurance claim received rupees 1,75,000 on 15th July. So I am going to incorporate this one for the third year. This second asset also originally purchased on 1/4/2010 for rupees 2,60,000. And this asset was used for 2010 and 11 and 12. During 12 and 13, in the mid of the year, probably 1st July, the machine was lost in fire accident. So in the third year, we have to provide the depreciation for the 3 months. Now we have to find out what is the balance available in the year beginning, right? Now 2010 and 11 depreciation here being how much? 39,000, and the balance being 2,21,000. This is for 1/4/11, right? 1/4/11 WDV. And for the 2011 and 12, one more depreciation is also provided for this 2,21,000. The depreciation being 33,150. If I subtract this, 33,150. Then 1/4/12, the WDV being 1,87,850. 87,850. Now, immediately as on the date, it was not sold. It was used for how many months? 3 months. So, now the depreciation is eligible for the current year for 3 months. You have to calculate for 3 months. At the rate of 15% for 3 months, what is the value? 7,044. If I subtract that, then what is the WDV on the date of sale? 1,80,806. 1,80,806. But it was lost in fire accident. The asset was insured, so I am getting the insurance claim, but not full value, only a portion. 1,75,000 I am receiving. So the amount I received here being 1,75,000. And out of 1,80,000 I am getting only 170. Balance not recoverable is loss, can be debited to the P&L account, which is 5,806. This is debited to the P&L account. This is debited to P&L account. Is that clear? Now I am going to record 3 items. Whenever the asset sold, you have to keep 3 items in your mind. Depreciation for the year up to the date of sale. Next, amount collected. Third, any profit or loss. So these are the 3. Here there is a loss. So I am going to incorporate all the 3. So this is 1. This is 2. This is 3. Okay. Now, all the 3 are going to be posted only in the credit side. The date of posting being 1st July 2012. Bank. I assume the amount is also collected on the same date, or insurance claim 1,75,000. On the same date, we have to provide for the depreciation. The value being 7,044. And on the same date, we lose this. So loss on sale. The value being 5,806. Now, cross reference. How did I get this? 3, working note number 2. This will be 3, working note number 1. And this is 3, working note number 3. Cross reference. Whatever the things you write in your examination, you need to give a cross reference. How did you arrive this? The examiner should not get tensed, or evaluator should not get any doubt that you might have copied, right? So you have to always give the cross checking, cross reference. And out of the 2, 1 is over. Now I am going to incorporate another one also on the same year. A new machine costing 4.5 lakhs was purchased on 1st October 2012. So I am going to incorporate that one also. The new purchases happens on 1/10/2012. 1/10/2012. And a new asset purchased. So bank. The value of purchase being 4.5 lakhs. 4.5 lakhs. Now, so for the year end 31/3/2013, you have to provide the depreciation. You have to provide the depreciation 31/3/2013. Depreciation, not only depreciation, balancing figure also. Balance. Is that okay? How do I get this? How do I get this? Okay. Already we worked out here the calculation of balances and depreciation. The same way, 4th working note I am going to prepare. Balance of the assets on 31/3/2013 before what? Before depreciation. How much is that? 563,500 plus 4 lakhs 50. 10 lakhs 13,550. 13,550. 10 lakhs 13,550. So 10 lakhs 13,550 minus bank depreciation, loss on sale, all the value put together, the value being 1,87,850. Isn't it? 1,87,850. What is the balance then? Yeah, 10 lakhs 13,550 minus 1,87,850. So the balancing figure is 8,25,700. Am I right? In this balancing figure, newly purchased asset and the existing assets. That's how we now classify this. The newly purchased asset being 4.5 lakhs because the entire balance is not going to be depreciated fully. A newly purchased asset will be depreciated proportionately since the date of purchase only. Balance asset could have been used to the full year, so that will be eligible for full year's depreciation. So I am categorizing that. So 8,25,700 minus 4.5 lakhs, this value being 3 lakhs 75,700. Now for this 15 percentage, for how many months? This new asset purchased on 1st October. From the date of 1st October to 31st March, only 6 months is eligible. Okay. So I am going to calculate for 6 months only here. Okay. Half year, 33,750. And for the remaining value, these assets were exist since the beginning, so it will be depreciated fully. 3,75,700 into 15 percentage will be 56,355. Okay. What is the overall depreciation? Add up these two. That's the overall depreciation. 90,105. 90,105. 90,105. How do I get? Working note number 4. And balancing figure could be 7,35,595. So the last year 1,413 balance. The balance being 7,35,595. We don't have any more purchases or sales in the year, only depreciation for the year end. So on 31 314 depreciation. You no need to calculate separately, only one asset is there. If there is any transaction, you have to find out the balance. Whatever the balance is there, no, is eligible for 15% depreciation for full year. So for that 7,35,595, 15% will be now applied. That 15% value here being 1,10,339. Now I tally this 7 lakhs 35,595, 7 lakhs 35,595. Balance carried down on that date 6 lakhs 25,256 and rewrite to the next year 1,414 balance. Okay, 6 lakhs 25,256. Is that okay? So if you work out this way, you can save the time also, right? On 1st April 2010, Messrs. NR Sons and Co. purchased 4 machines in the very first year. This is the thing happened in the very first year. In the second year, on 1st April 2011, one machine was sold for rupees 2,05,000. This is the thing happened in the second year. Okay, second year. On 1st July 2012, 12 and 13, in that year, third year, the second machine was destroyed by fire and insurance claim received rupees 1,75,000 on 31st July 2012. So one of the asset was destroyed in fire accident. Not only that, another a new machine costing 4.5 lakhs was also purchased in the year 12 and 13, 1st October. So in 3 we have 2 transactions. One is lost in fire accident, another one is new purchase. And books are closed on 31st March every year, so the closing date being 31st March. Depreciation has been charged at the rate of 15% per annum, and the method followed here being diminishing balance method. But I am going to rework out this illustration under SLM method. SLM method. You are required to prepare machinery account for 4 years till 31st March 2014. Calculations to be shown in nearest rupee. That's all. Now, machine account. Machine account. The purchases of 4 assets happens on 1st April. So 1st April 2010. Machine account debit to bank. Machine account debit to bank. The value being 10,40,000. One asset being 260. 4 machines purchased, so 260 into 4. 10,40,000 rupees. and no transaction happens in the very first year, only purchases. So in the year end, we have to provide the depreciation on 31/3/2011. Depreciation. Depreciation will be calculated at the rate of 15% under SLM method, straight line method or original cost method. 15% on 1 lakh for 10 lakhs 40,000 rupees being 1,56,000 will be the answer. Now I am closing this. 10 lakhs 40,000. 10 lakhs 40,000. And then the balance carried on being 8 lakhs 84,000. In the next year, 1,411 opening balance 8 lakhs 84,000. In the second year, we have one asset sold. Okay, I will work out that separately as a working note. The value of the asset being one of the assets, right? So 2 lakh 60. The asset is used for 1 year only. Now it is sold. 1 year only, and now it is sold. Now depreciation 2,60,000 for that 1 year depreciation being 15%, right? 39,000. Today it is worth rupees 2,21,000, but sold for 2,05,000 rupees. 2,05,000 rupees. Because of the sale value being less than the book value, we lose. The difference being 16,000 is a loss. This is loss. So immediately I am making the record of this. No depreciation in the year of sale. No depreciation because the day one itself it is sold in this year. So it might have been already depreciated. So we won't depreciate for the year of sale. 1,411. 1,411. Amount collected. Bank account debit to machine account. Bank account debit to machine account. The value being 2,05,000. And we lose 16,000 rupees. Loss on sale. This value being 16,000. 16,000. Okay. That's all. No more transactions. So for the year end. The year end being 31/3/12. We have to create the depreciation for the year end. And then we'll get the balance carried out. Now, I'm going to calculate the depreciation here. Depreciation for that year being 2,60,000 is the original value of one asset. Remaining assets we have as on this date being only 3 assets. For the 3 assets, rate of depreciation being 15% under the SLM method. So original value. On that original value we have to calculate. So 260 into 3 into 0.15, 15%. 1,17,000 will be the depreciation. 1,17,000. Okay. So the balancing figure is 6,63,000. 6,63,000. Am I right? Verify this value. No, I think so. It's not 6,60,000. 5,46,000. Very good. Now the total being 8,84,000. 8,84,000. And here on 1,412 balance 5,46,000. Now we are in the year 12 and 13. In year 12 and 13 we have 2 adjustments. One of the adjustments being loss of assets in fire extent. I will work out that separately. The loss happens on 1st July 2012. The asset being 2,60,000 and the asset is originally purchased on which date? 1/4/2010. Means this asset was used for 2.25 year. 2.25 year. You can now claim the depreciation for this for 2.25 year directly, 2,60,000 into 15%, and then the depreciation is meant for 2.25 year. Okay. As central straight line method of depreciation, you can get the value directly, 2,16,000 into 15% into 2.25 years, 87,750. Now if I subtract this value from 2,60,000, the ultimate value being 1,72,250. But this one sold for how much? 1,72,250 not sold for insured. No, we are getting the insurance premium of how much? 1,75,000. So I am getting 1,75,000. Okay, 1,75,000 is sale value. I am getting 2,750 rupees more than what I expected. Then here it is profit. Profit. Am I right? Is the calculations okay? 2,60,000 rupees for that 15% is rate of depreciation for the years of usage. The years of usage here being 2.25 years. Okay, once the year of means on the date of sale, whatever it may be, you have to post 3 items. One is depreciation for the current year up to the date of sale. Number 2, amount collected, and number 3, any profit and loss on that. Now, depreciation for the year of sale. Depreciation for the year of sale, 2,60,000 and 15% for the year of sale. It is used for 3 months, so into 3 by 12. Into 3 by 12. Now, this value being 9,750. 9,750. This is the depreciation. So 3 items are going to be recorded: depreciation, sale value, and profit and loss because of the sale. So I am going to post that here. On 1st July 2012, depreciation 9,750. 9,750, and bank, the amount collected, not bank or insurance claim. On 1st July, we just requested for insurance claim, accepted for 1,75,000. Anyhow, it's received on 15th July, so I assume this is being due. So due entry is passed. Insurance claim account. The insurance claim receivable is 1,75,000. In this scenario, I enjoyed the benefit. That will be now debit. It should be posted in the debit side. So 1,712. Profit on sale. Profit on sale. The value being 2,750. 2,750. Is that okay? Now, means fire extent is over. The another transaction is the purchase of new asset. For that, the entry being machine to bank. The purchase happens on 1st October. So 1st October 12, machine account debit to bank. The value we paid here is 4,50,000. 4,50,000. 4,50,000. Is that okay? Now, for the year end, 31st March 2013, we have to create the depreciation and then the balancing figure. Okay, balancing figure. So I am going to calculate the depreciation for this year. We have 2,60,000 rupees worth asset 2 in total, because one asset was sold in 11 and 12. Another asset sold in 12 and 13 the current year. In the current year, we have created the depreciation to the date of sale already, which is 9,750. And by the year end, we have only 2 existing assets. For the 2 existing assets, we have to create the depreciation at the rate of 15%. 78,000. Am I right? Apart from that, we have purchased one more new assets for rupees 4,60,000. For that 15%, but we have used it only for half year, 6 months. So into 1 by 2. Then the value being, this is 4,50,000, right? 450 into 15 percentage, yeah, divided by 2, 33,750. Now overall depreciation being 1,11,750. Am I right? 1,11,750. Find out the balance here. So you have to tally this and get the balance. 5,46,000 plus 2,750 plus 4,50,000. 9,98,000. 9,98,750. 9,98,750. What is the balance value? Seven lakhs 2,250. Am I right? Yeah, 7 lakhs 2,250. And in the next year, the last year, 1,413, opening balance being 7 lakhs 2,250. In the last year, we have only depreciation, no more purchases, no more sales. So 31st March 2014, depreciation. The depreciation here being 2,60,000 worth asset number 2, 2 numbers, and one asset being 450 rupees, 4,50,000 rupees. This is what about the original value of the assets we have currently. 2,60,000 rupees worth assets, 2 numbers, and one newly purchased assets in the previous year, 4,50,000. So 2,60,000 into 2, 5,20,000 plus 450, 9,70,000 is the full value. For that, the depreciation being 15 percentage, 1,45,500. Okay. So 1,45,500 will be the depreciation for this year. If I tally, then I will get the balance here. 7,02,250. 7,02,250. Okay. The balance being 5,56,750. Am I right? Balance carried out. Cross verify the number. 1/4/2014. Opening balance being 5,56,750. Stop here because we are supposed to prepare only for 4 years. Five marks question, we have to prepare for only 1 year. Only 1 year. On December 2011, 2 machines which were purchased on 1st October 2008, costing 50 and 20 respectively, had to be discarded and replaced by 2 new machines costing 50 and 25. In which year? December 2011. One of the discarded machines was sold for ₹20 and then the other for 10,000 rupees. The balance of machinery accounts as on 1st April 2011 being 3 lakhs. Against which the depreciation provision stood at rupees 1,50,000. Depreciation was provided at the rate of 10% on reducing balance method, which is nothing but WDV method. Right. Let's see here. We have to prepare only for which year? This year, April 2011 to 31st March 2012 only. Machinery account. Machinery account. Okay. And then we have a provision for depreciation account. Provision for depreciation account. Okay. And then we have a machinery disposal account here. Machinery disposal account. Machinery disposal. So in this case, the asset sale, sold or disposed is routed through the machinery disposal account. Okay, you have to understand. Whenever any asset sold and it is routed through the machinery disposal account, means the value of the asset sold will be transferable from that concerned asset account debit to concerned asset to machinery disposal account, transferable from here to there. And accumulated provision should also be transferable from the provision for depreciation to machinery disposal account. So here I am transferring the provision for depreciation also here, and asset value will be transferable from here to there. If the asset sold being having a original value of 100, then it is transferable to the machinery disposal account, and depreciation on the asset sold being say 40, that should also be transferable to the asset disposal account. Then whatever the sale happens, it's routed through the machinery disposal account only. Is that okay? This is the model here. Now I am going to prepare for only 1 year, 2011 and 12. In 11, initially we have 3 lakhs rupees as assets value, provision for depreciation being 1 lakh 50. 1 lakh 50. Let's see here. In the year beginning, 1st April 2011, balance brought down 3 lakhs, and here 1/4/2011, okay, balance brought down, the value being 1 lakh 50. Okay, here 2 machines which were purchased on 1st October costing 50 and 20 respectively had to be discarded. Then automatically any asset sold, the original value of the asset sold will be transferable from the machinery account to machinery disposal account. Right. On which date? December 2011. I assume that sale happens exactly on the last date, 31st December 2011. Machinery disposal account. 2 assets, the value of the both assets being 70,000 rupees. I transfer that to the machinery disposal account, 31/12/11. I am not aware about which date it sold, but it can be assumed to be sale happened on the last date. Machinery account, 70,000. And don't forget to transfer the accumulated depreciation on that from the provision for depreciation to machinery disposal account on the same date, 31/12/11 and 31/12/11. Machinery disposal account. Here provision for depreciation account. I need to know the value here. These 2 assets were originally purchased on 1st October 2008 and sold on 31st December 2011. So it should be now depreciated up to the date and find out the accumulated depreciation on the assets sold also, one after one. On 1/10/2008, the original value of the asset being, I club these two, 50 plus 7, 20, 70, rather than showing it separately. I can club both because both the assets will be attracted to the same rate of depreciation. The value being 70,000, and for the year 2008 and 9, it is eligible for depreciation for only half year at the rate of 10% on this, because this is WDV method. And since the date of purchase to the year end, only half year is there, so we have to calculate for half year. 3,500 will be the depreciation. Then the ultimate value being 66,500. This is the WDV. WDV as on which date? 31st March 2009. 31st March 2009. 1 year is over. But sold as on this date, right? So 2009 and 10, we have to again claim the depreciation for 1 full year. 6,650. Okay, 10% on this. Now after subtracting the value being 59,000, 850. This is WDV as on which date? 31/3/2010. Again one more year, year 10 and 11 depreciation. For this 10% will be 5,985. Okay. After subtracting the WDV and on 31/3/2011 being 53,865 and depreciation for the year of sale as on 31st March 2011, 31st December, sorry, 31st December, because it sold on 31st December. For almost 9 months, we have to now create the depreciation. So 53,865 into 10%, and for 9 months, the value being 4,040. Am I right? 4,040. If I subtract the WDV value as on the date of sale being 53,865 minus 4040, right? 49,825. 49,825. Where both the assets sold for, okay, has to be discarded, replaced by 2 new machines costing, okay, this one of the discarded machine was sold for 20 and then other was 10. I have put the value collectively. So both the assets having the WDV as on that date being, okay, 49,825. 825. Okay, 825. Now, both the assets sold for rupees 30 only. 30. And balance being 19,825. 19,825. This is loss. This is loss. Now, whenever we sell the asset, as on the date of sale, any accumulated depreciation on that will be transferable from the provision for depreciation to machinery disposal account. The original value being 70, and as on the date of sale, the WDV of the asset being 49,825. The difference between these two is the accumulated depreciation of the asset sold, which is 20,175. Am I right? 20,175. That 20,175 should be transferable from the provision for depreciation account to machinery disposal account. Okay, on disposal I get cash to the extent of rupees 30,000, and loss on sale is also there, loss on sale, which is 19,825. 19,825. And on the same time we purchased new asset also, valued rupees 50 and 25. 75,000 rupees is the new assets value. The date of purchase being 31st December. It is assumed, because purchase happens in December, we assume that the purchase happens the year beginning, period end. So bank. Both the assets put together purchased for how much? 75,000. 75,000. Is that okay? Whenever we sell the assets, 3 items to be recorded. One is sale consideration, another one is profit and loss on sale, another one is depreciation for the year, which is 40/40. As we are following the provision for depreciation, depreciation for the year should be transferable to the provision for depreciation account. Here, on 31/12/11, depreciation on the asset being sold, discarded, 40/40, both the assets put together. Both the assets put together. Is that okay? Now, if I tally the machinery account, it will be automatically tallied. Verify this. Because 70,000 is the worth for the assets. As on the date of sale, we have created provision for depreciation to the extent of 20,175. Leaving that, amount collected is 30 and balance is named as loss. So, always the machinery account will be getting tallied. Getting tallied. Now we have to find out the depreciation for the remaining assets for the last year, last date 31 3 2012 depreciation. This depreciation is for the asset discarded. This is the depreciation to be calculated for the remaining asset. Right. Before I calculate, I will close the machinery account. As we follow the means provision model, provision for depreciation model, machinery account will continue to appear at its own original value. 3,75,000. 3,75,000. If I subtract 70,000 rupees, then it is 3,05,000 is the balance carried out. Balance carried out. Now, find out the balance of provision for depreciation. Find out the balance for provision for depreciation. Yes. Yes. This is working out number 1. Number 2. Asset balance, machinery account balance being 3,05,000 and provision for depreciation account balance. How much is that? 1,50,000 for 1,59,040. From there we have to subtract 20,175. 1,54,040 minus 20,175. 1,33,865. From the original value of the asset, if you subtract the accumulated depreciation, the balance is nothing but what? WDV value before the depreciation. WDV value before the depreciation. Once you are aware about the WDV of the assets, you can calculate the depreciation on that. Now, what is the value here? 3,05,000 minus 1,33,865, 1,71,135. In this, newly purchased asset being 75,000, balance being existing asset 96,135. Existing asset will be depreciated at 10% usual rate, 9,614. New asset will be depreciated at the rate of 10% since the date of purchase. It's purchased on December end. January, February, March, only 3 months rate of means depreciation will be eligible. So find out that 1,875. The overall depreciation for the last year being, yes, 1,875 plus 9,614, right? 11,489. 11,489 will be the answer. Okay. Now, if you tally, then you will be getting the balance carried on. You will get the balance carried on. Yes. Find out the total of provision for depreciation in the credit side. Make it faster. I think the total being 1,65,000. 1,65,000. 329. 329. 1,65,329. From there, 20,175 is subtracted to find out the balance of 1,45,354. Okay.